Thank you everyone for joining us this afternoon's FF Live session, which we're proud to be co-hosting with our partners Wilson Sonsini on raising growth capital from U.S. investors. I'm Spiro Ladeas, head of content at Founders Forum. Founders Forum is a global community of top tech founders, corporate CEOs, and senior investors. While our community is unable to gather in person, we're very pleased to be bringing you our virtual event series, FF Live. I'll hand over to our moderator in a second, but just some housekeeping rules before we get started. On live streaming, this session is being streamed to our Founders Forum LinkedIn page as we speak. So welcome to everyone joining us there. Please do pose your questions to the panelists via the comments. These are being fed back to the moderator by our team. A recording of the session will be posted on Founders Forum YouTube page once this is over. So please head over there and subscribe and share with friends. On the Q&A for the second part of the discussion, for those of you on Zoom, please submit your questions via the chat box and be sure to send to everyone. Our team is moderating these behind the scenes. If you're with us on Zoom, you'll be invited to ask your question directly and you'll be unmuted when called upon. So please switch on your video when you ask your question and introduce yourself so we know who you are. I'm now pleased over to hand to today's guest moderator, Michael Labriola, partner at Wilson Sonsini's London office, which provides US access and support to tech-driven UK companies throughout their US lifecycle. Michael, over to you.
Thank you, Spiro. Hi, it's Mike Labriola from Wilson Sonsini. As Spiro mentioned, we're a US-based law firm, although I'm based in our London office, and we support the technology, life sciences, and emerging growth sectors through all stages of their companies through all stages of their growth. And with me today, I've got a fantastic panel. I'm actually really excited about this because you're going to hear a lot from them around, how to expand your business using raising capital overseas or outside the UK with primarily with US investors. Had the pleasure to work with a number of the folks on the panel. And I think you're going to get some really interesting insight from them because they all have had a kind of different experience and a different angle on a lot of the different fundraisers here. So I'm just going to briefly go down the list here. So as you saw before, we've got Jason Dupreez from he's the CEO of Privitar. They recently raised a growth round earlier this year from a US investor, and they have been doing great work in the enterprise software space for data privacy. I'll let him tell you a little bit more about his company there. Hussein Kasai, who's the CEO of Onfido. Onfido, as you probably saw earlier this year, raised a nice size growth round from US investors after several rounds here in the UK. They're in the AI space, focusing on ID verification. I've also got Catherine Burkett, who's the CFO of GoCardless on as well. GoCardless is in the payment management space, and they raised in 2019 last, but they're actually probably one of the earlier rounds for kind of big growth rounds from cross-border financings in the kind of the current UK tech economy here. And then Toma Hovogainen, who's the CFO at Checkout. Toma and his team, they recently raised 2 rounds, both one in 2019 and then again in 2020 from a collection of investors all over the world, but anchored by US investors there as well. And they are in the payment management system with folks on e-commerce there. So I'm going to kick off here with just a couple of themes that we want to tease out in this discussion here. One is really talking about the decision behind all of these fantastic companies and their management team on going to US investors. What drove them to make that decision to kind of leave their home waters here, so to speak, and seek out investors in an entirely different geography than they had in the past year. And then secondly, how has it played out? How have they benefited? How has it been a hindrance? What worked, what didn't work? Really want to make this a session that is helpful for all of you who are listening in, because we hope that many of you will also get to follow in their footsteps and will learn from their own experiences and grow the tech ecosystem further here. So with that, I'm going to actually ask them to do a little deeper dive on their respective companies and experience here to start with. So I think Tomas had graciously volunteered to go first here, but we'll start with him. But really want to hear a little bit about each of you. Your role with the company, how you ended up there in a nutshell. A little bit about the company. I think everyone's got a little sense of what the company does there, and then about your most recent raise with U.S. investors, or not just the most recent, but you're raising with U.S. investors. So, Tomas, you want to kick it off there?
Absolutely. Thank you, Mike, and good afternoon, everyone. So, Thomas Hovagimian, I'm the CFO of Checkout.com. As Mike mentioned, recently led our Series B fundraising process, which we closed just a few weeks ago in June. In a previous life, I was an investment banker. So a few words about the company, just for context. Checkout.com, we enable e-commerce merchants to, at a simple level, accept payments online. We do this via a unified platform, and we do this on a global basis. Our technology was designed for scale from the beginning. So, we aim to lead to superior performance for our online merchants with speed, data visibility, acceptance rates, etc. We're UK headquartered. We have 13 offices all around the world, 4 in Europe, the US, the Americas in the form of Brazil, Hong Kong, Singapore, Dubai, and more recently Australia. We support merchants in each of those locations, and we're able to provide a global tailored payment solution via our wide network of localized agreements and regulatory licenses. Then lastly, Mike, to your point, so about the raise, in June, we did raise a $150 million Series B, which was led by Co2 Management, which is indeed a US investor that valued the company at $5.5 billion. Interestingly, all of our existing investors, including Insight Partners out of New York, but also DST Global and GIC, also participated in the round. And prior to this, and I believe Mike hinted at this, we also did a raise 12 months ago. The first raise, it was our Series A, $230 million, which was led by Insight Partners.
Thank you, Tomas. Let's go to, I can see Jason next on my list here. So Jason, you're gonna be the next guinea pig here. So you want to tell us a little bit about Privitar and your experience in your most recent raise, and just a little bit about the facts around that most recent raise would be great.
Yeah, sure. So thanks, Mike. Great to be here. I'm Jason Dupree, CEO and co-founder at Privitar. My background, very much enterprise software. Started my career as a software engineer before starting a company in 35, which I sold to Thomson Reuters. So Privitar is my second startup. We didn't really raise money in 35, so I've done the organic story as well. Privitar, though, is a B2B enterprise software company. We provide a platform to organizations to enable them to manage sensitive data, largely for analytics, data science, data sharing, and increasingly cloud projects, cloud migration. The platform itself enables the application and management of privacy-enhancing technologies, which enable our customers to open up sensitive data for practical use. And we do this at scale and enterprise complexity. We operate across a variety of industry verticals, so very much a horizontal play across industries, financial services, healthcare, life sciences, telco, and geography. We were founded here in London, and so the majority of our people are still here. We're about 180 people today. So corporate functions and the majority of product research and development are based in London in the UK. But we now have about 60 people in the United States, Boston, New York, and Austin being our major centers, and then teams in APAC. We've opened a dev center in Warsaw, so really embracing that international expansion. In terms of the capital raise, we raised our first major VC round, our Series A, with a European investor, with Partech. So our first major investment from outside of Europe, from the US, was with Accel. They led our Series B in July 2019. And then much more recently, we closed our Series C, also from a US lead investor from Warburg Pincus. And we closed that also in about June, July. So have raised now about $150 million in total to date with those lead investors.
Thanks, Jason. And actually, I'm going to kick it to maybe to Catherine next here, since you mentioned Accel was in you guys. They're actually another Accel portfolio company there. Catherine has them on her cap table as well. So maybe Catherine, you want to tell us a little bit about GoCardless and kind of kind of just the facts on who you guys have raised thus far from investors, particularly outside the UK and US investors.
Yeah, so GoCardless basically is a payments business, but we very much focus only on bank-to-bank, so direct debit in the UK, but using other sort of banking schemes, be it SEPA in Europe or ACH in the US, to allow direct bank-to-bank payments. It's all pull mechanism, so we're focused entirely on merchants collecting. And we, as I said, are now international, and our big kind of pro point is all around. We believe that we sort of excel at what we do in the bank-to-bank space, and also that we're a really good solution for recurring payments. Merchant base is spread from a big SMB base in the UK, but up to some much bigger enterprises, and increasingly international. We have sales teams out on the ground in Germany, France, US, and Australia, as well as obviously in the UK. We're around 400 people as we sit here today. So give a bit more context to the GoCardless story and as far as fundraising. So I've actually only been with the business about 20 months. My previous career was spent for 18 years at a telecoms business called Interroute, where I also had kind of extensive fundraising experience, and eventually at the later stages with US later stage private equity investors. But I joined GoCardless after we basically sold into a successful exit, and I joined GoCardless after a 6 months break. And I joined just at the point as which we were closing our Series E fundraise, so I was definitely not around for the early stage stuff. However, GoCardless was, I do obviously know the story, but GoCardless was a business that was actually founded through the YC Incubator program out in the Silicon Valley. So we have a US topco because it's impossible to be part of that program unless you have that, and also pretty impossible to get rid of it thereafter. So we do have, we do sit with the US topco already, which actually makes well, I'm sure we'll come on to it later, but it does make the US fundraising that bit easier. Started off basically with the YC funds, and then effectively grew through sort of various VC backers. We've got Notion, Boulderton, Passion. Then we brought on Accel, as Mike said, who came on, I think, in Series B or C. I'd have to double check that. And then we did our last fundraise, as I said, which was actually Series E. Series D was just a top up of the investors that came on board during Series C. And effectively then our Series E raise was the biggest, broadly speaking, about $100 million. And we raised that from a combination of existing investors into GoCardless, as well as bringing on board some new investors who were, a couple of minorities, but also Google Ventures and Adam Street. Adam Street being much more of a growth equity fund based out in San Fran. So we've got a broad mix of both US and European investors. Most of our board actually is physically based in the UK. The one exception to that is our Adam Street board member who's based out in San Fran.
Great. That's fantastic. Thank you, Catherine. And then I think Hussein, if you could round us out here, and I'm gonna make one confession to Hussein, which is I just had to renew my driver's license, and the first thing I thought of was I have to scan it and get it back to you so you can add it into your database here. So Hussein, take us away about Onfido.
Thank you, Mike. I hope you did get to renew it. So I'm one of the 3 co-founders and the CEO. We started the company 8 years ago, back in 2012. Went through a fair few rounds of funding. The last round was led by TPG Growth, and that was $100 million. We were lucky enough that Mike helped. And so we historically, as a European company, our first few years of growth was predominantly in Europe. So we had Wellington Partners, Idinvest, later Crane Ventures, then Salesforce Ventures and M12 or Microsoft Ventures, all were investors. And the US is our largest market and our fastest growing market. So I had been planning for a while to get, to ensure our Series C essentially was led by a large US fund. And in the run up to that, we were lucky enough to have a few smaller funds, Tuesday VC and FinVC and others join our earlier rounds to help us navigate through what we need to put in place in order to eventually have our US investors invest. And on what the company does, so as Mike alluded to, we focus on digital identity verification. So we have about 1,500 businesses as clients, 3/4 are financial services. A fun fact is that GoCardless were one of our very first fintech customers going 6 years back. And in essence, if you're like an online bank, then as customers are registering, they're asked to take a photo of their ID and a short selfie video. And then behind the scenes, we're using machine learning to verify that the ID is genuine and not fake, and that the person's face matches the ID. In essence, replicating what used to happen face-to-face inside a bank branch, but making it digital. And we're just a team of about 400. And that's a bit of an overview.
Thank you, Saeed. That was great. And actually, I'm going to kick it back to you for our first question. And just a reminder for the group, we're going to take a check halfway through here and see if anyone has questions from the group. So feel free to send them in via the chat. But Hussein, I think just kicking off with you, if you don't mind, tell us a little bit about that initial draw to U.S. investors. Now, you went through a couple rounds where you were, you did kind of the classic raise from a number of the funds here in the UK and in Europe. And I think, my understanding was there was a draw there that was both, commercial and it was growing the business, but it was also, finding the right check size also. So tell us a little bit more about what drew you into the U.S. For that fundraising round, because I think you were pretty methodical about it. I watched you kind of from throughout pieces of that, and you were very thoughtful about how you kind of made that step.
So traditionally, the idea has been that U.S. funds offer bigger check sizes, and that may have been the case a few years ago. But now you have quite sizable, not just European, but Eastern and other investors that would write large checks within Europe. So naturally, US funds do write bigger check sizes, but that's not necessarily unique to them any longer. The big drive really was the playbooks that they have. And as we know, some of the most successful, I would say the vast majority of the most successful software companies, especially across the world, are headquartered and have come out of the States. So you tend to have this talent pool, and a lot of them do get involved in the venture world. So that if you are fortunate to have a US investor that is supportive, then they can offer their playbooks and their support and sort of advice that you may not have as much access to in Europe. So that was a big drive as far as helping the company scale. Empower, and then we from the outset, we did get onto those conversations pretty early on. So we were fortunate with TPG Growth. They showed us the work that they do with Uber, with Airbnb, B2B portfolio, and others from the outset, and that helped. Another factor that kind of comes into it is credibility of being a US company. So the US is our largest market and our fastest growing. And as we're selling more into the financial services, especially the mainstream banks, it seems like, and this is increasingly the case, they want to know, do you have US backers? And how local do you appear? In the States in particular, it seems as though there is a tendency to prefer a company that at the very least understands the local market, if not preferably is a local provider. So by having a US backer that is a recognized brand, that helps, especially given that in whether it's the East Coast or the West Coast, again, the financial service community and the investor community, the bank community is a very relatively closed and small group of people. So when it comes to brand and credibility, that is another big factor that comes into it. If there's one final thing to say is the valuations in the US are healthier. Like if you take a like-for-like company, London headquartered or Bay Area headquartered, you do get a Bay Area multiple. Never mind that you have all the cost advantages and everything else and the talent pool access of Europe. So there is a discrepancy. And in my view, the US funds are recognizing that, and that's why they are looking to do more deals in Europe. So we're probably going to continue to see a lot of activity from US funds looking to invest in European companies.
I think we Americans also can't seem to figure out currency translation as readily as everyone here in Europe. So, we're willing to throw down bigger checks, I guess. Hey, Jason, let me ask you to touch on that, because I think the Hussein's comment about the credibility factor, I think, is really interesting. And in the space that you're in, it's definitely it's a key area there. Tell us a little bit about how you guys entered the U.S. market, and kind of the push versus pull element of how you guys got to working with Warburg, and how did that dynamic affect your kind of commercial position in the U.S. there as well.
Yeah, so I think we started out in much the same way in 2015 here in the UK. Our first customers were based locally, although necessarily we were selling into the enterprise segment. So a lot of our early customers were also global operators, but really our footprint was European. All our people were here. And so when we raised our Series A, we really looked locally to find a fund that was aligned to our ambitions at the time. And I think actually, that's probably one of the most important points. When we're raising money, you're essentially growing the team. I look at it that way. You're recruiting somebody to your board, but you're extending the team. And it's really important to find that philosophical alignment of ambition, and the right chemistry with that incoming investor, regardless of where they're located. But then, like any enterprise software business, a huge main market is the United States. It's the biggest central market globally, and I think to win globally, if the ambition is to win on a global basis, then you need to enter that US market, and you need to win that US market. And as a European company, you probably need to enter earlier than is ideally comfortable, because that's where the competitive force is. That's where a lot of your sort of early adopters are going to be from a customer perspective, even early majority. So I think that's what drove that decision for me. And really it was about, once we'd established some early traction in the market, we'd picked up a few customers. So we'd established that we were relevant in the US market. We had those proof points. I then looked to find a partner that could bring many of the things that Hussein mentioned. So, credibility is a really important aspect of this with customers. So, market credibility, but also, really importantly with talent. So as you start to recruit in the United States, the brand and recognition that you can get from a credible investor with people is a hugely important factor. So that was really important to me. And then you get that connectivity, you get the playbooks and the operating experience that comes with a firm that's willing to engage and support that expansion. So all of those things were really important. And so that's what drove our decision to look in that direction for the Series B. And we brought Axel in, at that point, really strong philosophical alignment, real strong alignment in terms of ambition. And, they made that a global investment from both Europe and the West Coast, which, was immediately very, very fruitful and very successful for us.
It's actually, Excel's an interesting fund, because they have boots on the ground here in London and on the West Coast. So you do get a pretty interesting access to their network, as we've seen with a number of companies there. Actually, and Catherine, that's a good segue to you guys. So you guys, started out as a YC company at GoCardless there. How did that influence kind of the thinking on ongoing U.S. investors? Was that early? Did you guys find that the company was going out earlier in that process because of that bias, or and how did that kind of change strategy or influence strategy necessarily?
Yeah, no, I definitely think, interestingly, coming in a little bit from the outside as well, obviously I've not been around at the time, that their approach to US investors is probably, or the approach of the team to US investors is probably thinking it much more the same as the current investor base, unless it being a different step from something that was already set out in the early days. I think some of that is purely, we've got the corporate setup already and the corporate structure. And interestingly, we basically, we were very European based, or in fact, to be honest, UK based, with all of our revenues coming from the UK until as recently really as 2017. And then very, very small. It's only the last 2 years where we're starting to, 19 and into 20 really, where there's been any really significant traction out into sort of the different markets. I know when we did the Series E, though, that then, a lot of the thinking had matured a bit, that we definitely need to try and bring on some US-based investors. And we believed, actually, I think a big of the drive was similar to what Hussein was saying, in that it was because we felt that would drive valuation. Even if we ended up ultimately raising Europe, by ensuring we went out to the US as well, that we would effectively get a better competitive tension through that process and ultimately drive valuation up. So that was a big push. I mean, in the end, it became a bit more of a mix. Google Ventures obviously US based, but also sat here physically, and then Adam Street clearly being completely US based with no office here in the UK. And the big reason as well was, again, some of the commercial rationale that's gone out there behind it. It's very much our strategy that we were going to attack the US, build a business in the US, try and do what we've done in Europe, at least in the UK, in the US. So that was a big reason and rationale behind the fundraise. And it's definitely been helpful, as you said, the one we, again, had the corporate structure, which does help, but also the fact that we've got US backers kind of on our board across a variety, be it through Excel, be it through Adam Street, Google Ventures, Salesforce Ventures are also a smaller investor. That has really helped in helping us to gain real traction in the US. Very, very early days, but still looking really good and positive. So, and I think we feel, the US will probably be our continued destiny, assuming that we are successful with what we're doing out in the States at the moment.
You guys it's like a chicken and the egg discussion between all of you guys here, because you all kind of came about it very differently. So it's quite interesting to see. Tomas, I'm going to ask you a little bit, because Checkout was another kind of unusual step to even go to investors. I think, that company grew for quite a while before you even took on third-party investment. So tell us a little bit about the initial kind of decision to actually go to investors, and what was the initial prompt to go to US investors in that whole dynamic there.
That's a fair point. And I mean, to your point, Mike, we did actually grow on a self-funded basis, on the bootstrap basis, for a very long while, right? I mean, we did start in 2012, and from 2012 2019 just consistently scaled the company, and along the way we had multiple opportunities to raise. You can imagine there's a fair few people who told us that it would be impossible to keep scaling the company and grow and achieve the global ambitions without raising capital, but we did remain relatively disciplined in scaling the company. And I think one of the elements to this is that from the outset, we always ensured that we're disciplined in maintaining that the company was profitable. I think this is a differentiating factor with a lot of companies in the space, in fintech in general, and in a lot of other technology businesses that essentially will find themselves in a situation that if they want to keep scaling and grow internationally, etc., and fund their growth and invest capital, will actually need to raise and dilute the company. And I think we have a bit of a different approach to this. And we scaled the company to 2019 without external capital. And at that point, we did realize that, to take the company on the next phase of its journey, it was probably the right timing last year, 12 months ago, to pull the trigger on a capital raise. Now, interestingly, and I think you're hinting at this, at that point we were still, and we continue to be very profitable, and we could have continued, essentially growing without external capital. But I think one of the realization is that, you know, people love to talk about the technology aspect of the business, and you know, in a world where 60% of our payroll is engineers and product people, I'm certainly not going to deny that you know, it is most prevalent. But what some people sometimes forget is that it's still financial services, right? And with financial services come a number of aspects, one of them which is really building the regulatory backbone and infrastructure that necessitates for us to go and offer payment services in all the multiple locations where we've been, you know, building the business. And, you know, we were originally just regulated in the UK via the FCA, but, you know, we've also obtained another EMI license in France, then in Singapore, then in Hong Kong, etc. And I think the reason I mentioned this is all those endeavors, you know, when you can show a very strong balance sheet, and that was the primary reason for going and essentially having, you know, both the Series A and the Series B exclusively primary capital. I think even though you don't have a, what I'm going to call a use of proceeds, so to say, because it's not cash that's, you know, going out of your balance sheet, I think it makes a lot of those conversations a lot easier, so to say. And so, you know, back to your question, I think, you know, we had reached a scale. So, you know, now we're 750 employees. At the time when we pulled the trigger 12 months ago, we were probably 500 employees less than that, right? So, and we were firing on all cylinders and opening locations. We had another, you know, 4 offices in that span. But I think there was really a drive of saying, listen, I think we're really building a global acquiring network. We are on a, you know, big endeavor of seeking a lot of licensing arrangements that sustain that ambition. We're also building a lot of product that come on top of straight processing. And it was kind of like the right moment to A, grow the balance sheet, B, you know, and I think that's back to Jason's point and Hussein's point, you know, associate, you know, ourselves and having in our capital some investors that had, well, A, the track record of scaling either enterprise software or, you know, like large scale financial services companies, and B, people who could share our vision on the product and really help us on this global journey of building the company.
Great. So I'm going to switch gears a little bit and get a little more tactical here for a moment. And then I think we've got a couple questions coming from the group, so I will probably, after we have our next little discussion, probably open it up a little bit for the group here. But more kind of at a more tactical level here, how do you even start meeting investors when they're 3,000-4,000 miles away here, right? So how did each of you guys do that? And Tamal, I'm gonna go back to you to start with here, because you guys ended up, you know, going through a meeting with a bunch of folks in your process there. You know, how did you go through that process? Did you you know, how did you, not having investors on your balance sheet before, how did you identify who were the real deal and who were the ones that you wanted to work with? You know, I think some of you guys have used bankers, some of you guys didn't use bankers. How did all that work? And how did you just build rapport with any of these investors? So Tamal, why don't you take it from there? So.
Yep, and I'll go reverse order. So during Series B, I think things were a lot easier, just because we had raised 12 months before, and we ended up disappointing a few parties that couldn't get involved in Series A. So I think we were deliberate in knowing exactly who we wanted to go to. That, by the way, also allowed us to run a very, very tight timeline. I mean, we started on the 19th of May and we closed on the 19th of June. So it was a 4 weeks all in, you know, process with very defined, you know, milestones. And we ran this in a very narrow manner. I can't, you know, necessarily disclose exactly the number of parties we went to, but it was really a handful, if that. And I think we were very clear on the terms, and we're very clear on the, you know, objectives of the round. But all of this was, to your point, Mike, very much having, you know, done the Series A 12 months before, and I think that set a bit of a, what I would call a precedent into walking into this one. Then, backtracking to your initial question, at that point, I think it's really a matter of having entertained those discussions for probably close to 6 or 7 years, of knowing exactly if we ever were to raise capital. You know, when it came to the Series A, we kind of had a fairly precise idea of who we wanted to get involved with. So I think it was really a matter of being decisive and you know, not necessarily going on a wide auction and entertaining a lot of discussion, being a bit targeted and deliberate. The last thing I'll say, because you ask, is that the last round we didn't, you know, involve any bankers for the same reasons I mentioned, is that, you know, we felt we had the skill set, you know, in-house, and we, more importantly, didn't want to get too distracted from running the business. Because, you know, when you're growing at the pace that many of, you know, I mean, all of the businesses in this call are growing at, I mean, any time you're spending on this is really dilutive to your growth and to your story. So I think it's fair to say that you just want to get this out of the way and go back to business, basically.
I'm going to kick the same question to Hussein here as well, because I think Hussein, I'm constantly amazed at how studious you were on your process on this one here, because you went and laid groundwork, I feel like, over time as well. And I thought it was interesting, Thomas, you mentioned, you know, 6-7 years of conversations. It's, you know, I feel like it gets increasingly harder when you haven't been through a cycle before. And so I'd be curious to contrast, for example, Jason and Catherine had prior experiences with other companies there. Hussein, I'd be curious to see how you kind of started to build that rapport, you know, as your kind of first time through with the company here. So how did you do it? So
I moved to the States for a lengthy period, especially over 2017 and 2018. And it's about being present at the events and doing the typical things that you need to do to show like we're here as a company to stay in recruitment and the infrastructure building, especially for a startup, a scale up. In my view, you ought to have a co-founder leading that where possible. So that helped. Building rapport, the key way was to share some pretty looking.
oh, Hussein may have frozen there. We'll see if we get him back. He was about to tell us the secret to the universe, unfortunately. So, well, maybe while Hussein is restarting, maybe we'll jump to Jason. Jason, I think you had. It's interesting. I think you called me and said, "Hey, we've got a term sheet." You'd already built rapport by the time that I think you got your term sheet. But the backstory is quite interesting. I'd like to hear how you kind of established that credibility. And then...
Yeah, I think, you know, in the early stages, you're definitely probably doing more pitching, like pre-Series A, seed, and so on. But as the company builds momentum and you get more visibility, you should start getting a lot of inbound inquiry, and that gives you an opportunity to build those relationships early. And so, you know, I run a separate CRM system for my relationships with investors, and you keep track of these conversations over time because, you know, as Thomas hinted at, you know, an investor may not be right for you today, but they may be perfect in 3 years' time. And there's a huge advantage to building that relationship, to, you know, showing track record over that period of time makes it a much easier conversation when you're actually stepping into a process. So, you know, with the Series C, which is a great example, you know, there was nobody on my list, and it was a very short list that I hadn't had an established relationship with for at least a year, I would say. And then, you know, we kicked off the process for the Series C. I went to the US. It was the 13th of February this year, and, you know, within a couple of weeks, we had you know, some relevant offers. One of which was Wahlberg, and they tell me they've never produced a term sheet in that record time before. So, you know, but it's down to the groundwork that had been laid in advance, and then of course, you know, you close the round, and there's a subsequent diligence process, which you know, it's always in your best interest to run as quickly as possible. So, you know, I would say, you know, the real wisdom here is, you know, build those relationships early. I'm not personally, I don't believe in the roadshow or the arm's length. sort of process. We've never used a broker or a banker either. I think, particularly in an early stage growth business, it's down to the founder or the senior executive to build those relationships and cultivate them over time, and then run a very tight, timely process when it counts.
It's interesting. I think the role of the founder and I'm going to ask Catherine to weigh in here as well, because I think Catherine, you come from a different place where I think you're as a known quantity as a CFO, and you've got a lot of time. You've got a lot of time dealing with investors as a CFO at both larger and smaller companies. There, I suspect you come in with a different role in that fundraising process, where they look to you and they go, you're kind of the underwriter, the stamp of quality to some degree. And it's not to suggest that the founders are not, but I always find it interesting how kind of someone's very successful teams use this mix of, the visionary, the experienced operator, that kind of thing. Tell us a little bit about how kind of you work with investors at GoCardless there, if you would, Catherine.
Yeah.
By the way, I did see Hussein's back on, so I just want to welcome him back here.
Yeah.
I think he's live, so that's good.
So yeah, I think basically, it's a really good point, because Hiroki had done basically everything himself, frankly, up until the point that we did the Series E. And on the Series E, the business didn't have a CFO at that point. When the initial fundraise was kicked off, I was going through the interview process, but I hadn't actually been appointed. And the existing board actually therefore insisted that they did use FTP partners to effectively run a process. So I actually did bring some advisors on board, just because I think it was felt that, clearly they didn't have anybody internally as well that could sort of help Hiroki effectively drive and manage the process. I mean, I think they did a reasonable job in the coordination for sure. And we did cast the net a little bit wider than just people Hiroki knew. But very interestingly, the funding that was raised was from somebody that Hiroki had a very, very long-standing relationship with at Google Ventures, and they actually brought Adam Street Partners on board, with as a joint investment. So I think that part is very interesting. But one of the big things that happened as the fundraise was closing, I was appointed, and it was part of the deal was that a CFO was actually sort of brought on board. And I will say that my hardest interview, and I'd actually signed a contract at that point, but it definitely felt like an interview, was actually with our US investor, who gave me a real grilling as I was joining the business. Thankfully, it seems I passed, but no, it was, and I think, as we grow further, and actually, should we do another fundraise, in the future, I think I will be a pivotal part of that. And I think that's right, because, Hiroki is obviously an incredible individual and absolutely fantastic from a numbers perspective as well. But he's also a founder, and he's also full of optimism about everything, and doesn't necessarily think about things that become more important as you get bigger, when he's sort of on the sales side of the business, which is absolutely right and appropriate. But I strongly, as a CFO does become, obviously I may say that myself, but a CFO does become a very important part, I think, of the management team and of future fundraising. And I think a lot, as you've said, Mike, a lot of investors do then look towards the CFO and the finance to be sort of their ears and eyes, to make sure. And I think that's definitely shown true through, obviously, the COVID crisis that we've all then gone into. And I think it's really helped Hiroki to have not just me, but sort of other members of the management team who are more experienced, as been through nothing like this, but have certainly lived through sort of the financial crisis, and for me personally, the telecoms crash in the early 2000s, on board to help guide us through, obviously what was going to be a pretty unknown situation.
I think it's amazing, actually. It's the blend of teams really goes a long way in kind of making sure that the company can kind of survive diligence, right? It's great ideas are great, but ultimately it's a team effort there in a lot of respects. So it's interesting to get that take as you got bigger there. I think Hussein's back on. I'd like to let him. He had as I was jokingly referring to, he was about to tell us the secret of the universe on his experience in talking to investors. And then I'm going to open it up. We got a couple of questions that are floating out here, so I'm going to open up there. So Hussein, if you can hear us, if you're back on.
I can. I'm sorry, I don't know what happened. But in short, I think in the earlier stages, relationships count for a lot more, because all you really are doing is it's a promise of your vision of the future. And if in the earlier stages, you may not have as many strong metrics to essentially prove that. So it's buying your vision, and you can do that so much better when you have these relationships. And over 2017, 18 in particular, I spent a lot of time building those. And with Crane Ventures, Scott Sage as a partner, I got to know 2 years before they led one of our rounds, and that essentially was important. I think later stages, as Thomas was mentioning, it may not be as important. It is important, but in essence, you've kind of proven a lot and you've got a lot more metrics, and you kind of want the metrics to do the talking. So in later stages, our round from essentially conversation to term sheet was about 4 weeks or within 4 weeks. And then the due diligence in itself was within sort of a 4-week period as well. And I would say, I know that there are founders out there who spend a lot of time with investors, and that has its place, but you're either in fundraising mode or you're not. And if you're in fundraising mode, you ought to be targeted. And often it's the partner within a fund is as important as what the fund is, so that you connect with them on their interests, and you basically keep them posted every 3 to 6 months. And so that when the right time is there, you'd hope that you've kind of already done the selling, and now it's just to share the metrics and why they ought to be backing you.
That's an interesting point there, Hussein. I actually think the personal relationship is pretty key, and it's also as I've kind of listened to, most founders throughout the conversation, like it's really they're like, oh, I like the access to this, I like the access to that, but ultimately, it's finding that investor, that partner at the fund that really kind of gets and understands your business there. So I think that's an interesting observation throughout there. So I think we had a couple questions that were sent in, so I'm going to pause for a second because we're starting to get to the end of our time. So I wanted to give an opportunity for some folks to chime in. I think we had a question from David Kellner, who sent it in advance. Izzy, I don't know if we want to see if David's on and give him a chance to ask his question here. So David, are you on?
Yes, can you hear me okay?
We can. Please go ahead.
Brilliant. Thank you. Firstly, thanks so much for the webinar. Very much appreciated so far. So my name is David Kellner. I lead the Growth Capital Solutions team at Numis, and we work with founders to help them raise growth stage capital. Recently, $450 million for Klarna as an example. I'm just really curious regarding broader dynamics that we're seeing in the growth capital markets. And I was curious to hear if others are seeing similar or different to what we're seeing, because it feels like there's been quite a big change. So it feels like after a COVID-induced pause, kind of for a couple of months, in the last 6 weeks, we've seen both a resurgence and a bit of a divergence in the growth capital markets. But on the resurgence side, it feels like following this COVID pause, there's been resurgent appetite among investors, and it feels like investors recognize that we've seen kind of 2 years digital adoption in a couple of months. We've seen impaired incumbents and stronger prospects for companies aligned with the new normal. And on the founder side, it feels like folks whose companies are doing well are keen to invest and often raise capital to kind of strengthen their competitive advantage with what seems like quite a unique window. So that's kind of on the resurgence side. On the divergent side, it feels like that greater appetite and those robust valuations are very much centered on the tier one companies that have also been COVID beneficiaries. And for companies that, sadly are a bit more impaired, it feels like appetite and valuation still remain much more challenging. And quite a few of those companies are deferring major raises to next year. So I was just curious to hear the panelists' perspective on conditions they've seen in the market, because it does feel like quite a change we've seen over the last few weeks.
Yeah, and I think for this group, maybe Catherine, you might be the jumping off, because you're probably talking to a bunch of your investors, and you guys are probably furthest from a raise here. So my guess is I'm going to maybe pitch to you to kind of kick off there. But I suspect, given that Hussein, Jason, you guys did the most recent raise kind of right at the peak of insanity, and Tama, you guys decided to kick it off at insanity wave 2. I think everyone's gonna had some battle scars from those recent up and down there, but would be curious, Catherine, I don't know if you've had any, because you guys are probably looking at it from a perspective of you're now 18 months out from last raise here, so I don't know if you have the observation.
Yeah, no, I mean, I think clearly our initial response to COVID was, well, right at the start, well, nobody has any certainty here what impact this is going to have on anybody's business. So that is sort of one of the things we wanted to make sure was that we pushed our next fundraise out. But that wasn't necessarily from a lack of appetite, more just it felt like the right thing to do, and that we didn't want to be in an emergency fundraise position even this year and in all honesty next year either. So we took it on ourselves to basically shore up our balance sheet, and that being a very sort of important step forward. But very interestingly, I mean, I'm seeing a huge amount of inbound interest into GoCardless because I think we are partly established. People probably can perceive that we're not going to be too badly damaged by COVID, and in fact, we are back now growing. So I think that we are actually seeing inbound interest, and from our investor base, it's really interesting actually because at the start of COVID, there were definitely some bears on the board, so to speak, who were a little concerned about kind of what the future looked like, and really airing caution amongst us. That was not all the board, but there were certainly some voices that were in more of that vein. The board now is, we're full of kind of optimism really about the future. And I think that's because they are seeing amongst different portfolios and amongst their own sort of LPs, etc., sort of appetite to invest more ultimately in the right businesses. I think it's probably quite hard if you are not established and you are perhaps, the timing was just really bad for you in the sense that, you really needed to do a fundraise, you're planning for Q2 and suddenly you're thrown into this situation. I think that, probably is very hard. But I think my take on the current, and having spoken to sort of all of our investors, is that there is funding out there, but probably with more diligence, and it's something what I'm coaching my own management team, that we need to definitely be prepared for, I think, more questioning around the bottom line as well as the top line. So at least understanding how you get to profitability, even if you're not at profitability as it sits here today, rather than it just all being simply about growth.
But Jason or Hussein, you guys, I think, went through the absolute tornado that was the initial market correction there. So I'd be curious as to, and then I think both of you guys had been working through additional pieces, investors coming in a little later on in the process there. How was the dynamic throughout that storm? So.
I mean, I think, as you say, Michael, we signed our term sheet, pre-COVID by, probably about 2 days before the real tornado started, before travel was banned from the US and so on, and things really kicked off. But we were fortunate, our investors stuck to terms, and there were no changes, despite the change in global macro. I think one comment just off the back of Catherine's comments, I think the one thing that I have seen, and we're not raising or anything like that at the moment, but just peripherally, is that there is capital, and it is coming in at good valuations into companies, particularly those that have established track record. I think the thing to watch out for is that, the sort of gold standard or best practice in terms of terms and conditions. And I know WSGR published some great research on this periodically, to show what is market on many conditions. I think we are seeing an element of more structure being attempted to be pushed into transactions. So more downside protection, perhaps tweaks of liquidation preference. So that is something for for companies to watch out for. You might get the price and the valuation, but also be clear on the structure and other terms and conditions that come with the offer, because I think that is probably, we've seen quite a lot of that recently.
Go ahead.
You have excess capital in the world, and there are fewer industries that return any sort of profit essentially, or have strong ROI. And so the tech sector disproportionately has and will probably continue to attract investments. Now, what COVID has done is essentially, even within the tech sector, create a more narrow focus around possible verticals that are going to be more resilient and maybe relevant to a post-COVID world. And that includes everything around infrastructure, be it payments, as we know. I'm sure privacy is a big part of it, whether it's communications like we're on Zoom today, or identity where we play. And so the growing in attention is probably going to be a direct result or reflects that, and it's unlikely to go away. Now, the hope is that very many of the very smaller startups that are fewer than 10 people and are just starting out, they're the ones that are going to struggle. So although we're going to continue in all likelihood with this wave, and companies at the scale-up stage will get decent attention and funding, there may be a long-term implication where smaller startups may not be getting as much attention as they have been over the last few years.
That's actually a really interesting observation. Is saying we definitely saw for a little while the kind of the swamping effect, where the big, the bigger companies got the attention and the little companies kind of said that had to wait for a while. So it's interesting. You'll see. You go back to 2008 in the financial crisis, and you saw the companies that came out of that, and it'll be interesting to see the innovation that comes out of that there. So, Tamal, you just recently, had the most recent close of all your rounds there, and you guys were, frankly, beating investors off from the last round here. So, any change in the behavior you found between the last round and in June?
No,
and how the investors were reacting in response to David's observations.
It's an interesting one, because, and I think it goes back to actually David's point in kind of outlining the two trends, right? And if you ask me, and I think Hussein and Jason were actually hinting at this or covering this another topic, is really that I think COVID only exacerbated something that you're already witnessing happening in the past 12 to 18 months, which is, yes, there's tons of cash or capital on the sidelines that's waiting to get exposed to quality assets. And in the current macro, I think a lot of investors are just simply more discerning into how they're deploying their capital. And the number, and that's regardless of verticals you operate in, the quality stories that will typically afford both the growth and an element of profitability story, and more importantly the ability to have the vision to print sustainable revenues, cash flows, like long term, is at the end of the day is probably less than before, and if anything is a bit of a day of reckoning for markets, because for the longest time, and that won't be a surprise to anyone here on the call, I think the markets were a bit binging on tech and growth stories, and I think if anything it's a bit more of a reassessment back to fundamentals. Now, don't get me wrong, I'm not rejoicing once again at the situation. I mean, COVID's been catastrophic for a vast number of businesses, colleagues, friends, families in the UK, elsewhere. So it's certainly not something to rejoice at for one second. But when it comes strictly to your question about capital raising, I think it's really forced companies, issuers to be disciplined, to be realistic about what they're building, and about the sustainability of their business model. And back to your question, Mike, I think we did take the opportunity in that window to raise at that time, because we did feel that we had a compelling story to offer in the current market.
I want to be mindful of time. We're down to just one more minute, and I want to make sure. I think we got a question from Manoj Ranawira here, who, by the way, I'm giving him the opportunity to ask his question because he put in a props for. He said Hiroki definitely did a amazing job. He was an early customer, and who thought you could make direct debit sexy? So Catherine, report that back there. But Manoj, if you're on, I think you had a question about GBX. If you want to ask that real quickly here for the panel.
Hi. I wasn't expecting to speak, but
sorry.
yes.
I can read it out if you'd like.
So I think the issue is that how do you actually go to US, right?
Oh, okay. And, you want to do that one? Go
ahead. So we've been looking at an organization called GBX. It seems to be run by experts in San Francisco. So if you don't have a strong network, I think that the question is, how do you build that network? And the second question I had was that if you are thinking of US, obviously you can't just you grab a flight, go over there and start talking to people, or would you rather actually try to build either a sales or customer service type function first? Which way have you guys gone? In terms of your raising investment there. What did you have to do at the very beginning to get the attention?
So why don't we, I'll throw that to each one of you, maybe one observation from everyone on the panel there on what did you feel like was the first kicking off point there to get attention from investors in the US there. So maybe Jason, you look like you're not ready for that one.
No, I'll give you my short contribution. I think for us, it was about customers. So we had to establish a sales beachhead and win a logo. So it was all about sales.
I would say exactly the same. So go there and yes, book a flight, backpack, go. Get your first customer and get your customer. Well, ideally, you want the founder of a customer, if possible, to introduce you to the portfolio and to a partner, wherever possible. And they like that. I've heard, and I sort of wouldn't be surprised. Partners that get introductions from your customers, there's nothing quite like it, if that is possible within what you're looking to do.
That's a great observation. Tamara, Catherine, anything you want to add to that?
No, I mean, we were a little different because we actually didn't have to, you know, sort of, we were getting the customers afterwards. So we had a story that was all global expansion. Yeah. And we obviously had the early stage, you know, sort of YC point, but we were able, I think being a little later stage, you can be perhaps less established in the US and still raise the US money in, because to be fair, we did that in through as well.
Yeah.
Manoj, I would say, and here I'm not focusing on the investor side, I'm focusing on, you know, operation, presence, sales, etc. But I would really think what's the value add ultimately. I think, you know, in a multiple markets and verticals, the US is very liquid and transparent and competitive and saturated to an extent, right? So I think in our case, and it's specific to our business, but the incremental value we end up adding for US, you know, global e-commerce name is our ability to support their, you know, global payment needs and not the domestic market, so to say, right? I think if we went there and just trying to compete for the local business, it's less attractive. And here the value add was really to think how we can accompany their own growth journey. So I would really suggest to look at what value your business can add, you know, to those customers and how you can accompany them across this.
Brilliant. Well, I want to thank our panelists. I realize we ran a little bit over time here, but I appreciate you all, and I apologize for taking you guys an extra minute or two past our timeline here. As a reminder, there's a couple more FF Live sessions. I think there's one today with my partner Dan Glazer, who's actually talking about US expansion as well. So enjoy those. And thank you guys. Really want to thank. This is a fantastic panel, and I'm really honored that you guys were able to take the time with us. So with that, I think we'll let you all have your day back. So thank you all.
Thanks for having us.
Thank you. Cheers.